And the recording has started. All right. So thanks for joining us, folks. We wanted to invite you today to share some Symetra updates with you, as well as some work we've done around the Accumulation Iul market. So before we get started, I just wanted to share a little bit of background on Symetra. Some folks still get the question, who is Symetra? Where did they come from? What's their story? And we think it's a pretty interesting story, so we like telling it. So we spun out of Safeco. Symetra used to be Safeco's P&C arm, and we spun out and went independent in 2004. We were then taken public by a combination of Berkshire Hathaway, which is Warren Buffett's company, and White Mountains, which is the private equity behind the Geico strategy. They recognized Symetra as a company with a very clean balance sheet. We didn't have any of the bad guaranteed business from the 80s on our books. We were poised for growth, so they came on board and took us public in 2010. I think Buffett made almost a 33% gain on his share price, so he did pretty well again there. And then in 2016, we were purchased by Sumitomo Life. So Sumitomo is one of the largest Japanese life insurance carriers out there. Japan has an aging population, and they were looking for a growth opportunity. So the U.S. offered them a great growth opportunity where we have younger demographics and rising incomes, and we give Sumitomo exposure to the U.S. through our distribution. So we grew from a $50 billion company to a $300 billion company by being acquired by Sumitomo. So we are now, from an asset standpoint, just as large as some of the other top players in the U.S. out there. So Symetra is no longer a little carrier. We're one of the big players, and we're here to stay. So to recap our current portfolio really quickly, before we dive into the good stuff, we have a term product, 10, 15, 20, and 30-year term, and we are very competitively priced at the upper end of the market. So on death benefits $2.5 million plus, we should be coming in top 3 in price. Later in March, we're very excited to launch a protection IUL to the market. This will be one of the secondary guaranteed products that has a guaranteed death benefit up to, say, 90 or 95, and also builds up some cash value. So the best of both worlds, shorter guaranteed death benefit and some cash value buildup. Our flagship product is our GUL, and that's a guaranteed UL with guaranteed premiums and guaranteed death benefit. Very simple product, very competitively priced if you're going to guarantee it out past age 100. And then lastly, what we're going to talk about mostly today is the Accumulation IUL. We have guaranteed bonuses, which are a real differentiator in the space, and we're one of the lowest cost products in the IUL market, with unique index options and high distributions and high target premiums. All right, so let's get into the good stuff here. So indexed universal life. What are the value of these solutions? Why are advisors out there selling them? So these products provide flexible death benefit options, but mainly it's the tax-free distributions and cash accumulation that's drawing clients towards these products. And then you can also include living benefits like long-term care or chronic illness riders. So what are the primary factors behind the customer's buying decision when it comes to these IUL products? And that's typically the illustrated distributions and accumulation values. So the sale of the product is really being driven by the illustration. And that's what we're going to dig into here, is what's in the background driving the performance in the illustration. And then as the advisors, what due diligence should you be doing on these products to understand how they work, to understand how they're generating that distribution number that's driving your customer's buying decision. And that's where Symetra IUL University comes in. We've been in the market for a couple of years now with our index product and noticed some learning gaps and some areas that we could really add some value through education. So we wanted to step back, peel back the onion, if you will, and dig into these products to show you some of the moving parts. So we've broken down IUL products to a pretty simple equation. Premium goes in, costs come out, we add back in an index credit, and that index credit is going to be amplified by some sort of bonus. Bonuses are big in these accumulation products. So that's what we're going to focus on today, are the bonuses. So IUL bonuses are carrier specific, they're positive selling points, They help the cash grow at a greater rate of return than the index is actually returning. You have multipliers out there that will multiply the return by a certain percentage. You also have bonuses that will hit the account value, so a smaller bonus based off the account value that will credit even in negative years. So one of the main points behind the bonuses is that these are included in your illustrations. When you run the illustration, the interest credit that's actually driving the performance is going to be made up of the index performance plus the bonus. So do know that your bonuses are in the illustrations, and there's even some carriers out there illustrating non-guaranteed bonuses. So this is my favorite page of the IUL illustrations. This is the policy charges page, and this is the page that shows you everything going into the policy and everything coming out of the policy. And what we want to highlight here is the interest credits column, because what we find is a lot of advisors that we work with and a lot of GAs as well think that the illustrations are running at the specified rate that they're inputting, be it 6% or 5.5% or 5%. They think the interest credit is going to be based on this rate that they're running the illustration. But it's actually a little bit higher. And all we're doing is very simple math. We're trying to figure out what rate of return the policy value needed to grow at to return that interest credit the next year. And what we're finding when we run these illustrations at 6.1 is that our product, the Symetra product, illustrates at 6.6 the first 10 years. I can tell you now that that's the 50 basis point account value bonus on top of the 6.1 illustrated rate. So we have the index return, which has been specified at 6.1, and we're showing an extra 50 basis points on top because we have a guaranteed 50 basis point bonus that begins year 1. Now you'll see year 11 on here. The illustration runs at 7.5%, and it actually runs at 7.5% years 11 plus. And this is because our persistency bonus, which begins year 11, has started to kick in. So there are two bonuses: account value enhancement credit, which is 50 basis points beginning year 1. That's as long as the client's allocated in our base index strategies, which have a 10% cap on the S&P index and illustrate at 6.12. And then we have this guaranteed persistency bonus, which is a nice way of saying, thank you for staying in the product. It's year 11, and we're going to give you an extra 15% to your credit. So we'll take whatever the index returns, we'll multiply it by 1.15, and this is what's actually going to hit the policy. So here it is again. Now you understand how our bonuses work, so you understand that the illustration's running a little bit above the 6.12 we're running it at. And our cash value 20 years out is going to be $733,000. And the example we're looking at here is a 1035 only on a 45-year-old male. So we're putting $250,000 into these accumulation products. This is our year 11 equation. So you want to break it down to real basic math. And this is why we say the Symetra Accumulator IUL is a transparent, easier to understand product out there, because we're able to back out of all of our numbers and explain exactly what's going on inside the illustration. So there's your 6.12. That could be 6, 5.5, or 0. That's your specified rate of return. Or if this is real life, that's the real rate of return the index generated the previous year. Starting year 11, you receive the guaranteed persistency bonus, which, like we talked about, is 1.15 times the credit. And then we add on the 50 basis point account value enhancement credit, and that's how we're arriving at the 7.5, which is a historic average plus our guaranteed bonuses that we're running the illustration at. One thing I love to point out here, let's pretend it's a 0% year, so instead of 6.12, we get a 0. That cancels out the front half of the equation, but as long as the client's allocated in the base index strategies, they receive the 50 basis point credit, so they'll always see positive interest credited. No years of a 0. I wanted to share a competitor of ours with you. This is the Pac Life PDX product. So again, we have the same 45-year-old male. We're putting $250,000 in. We've run this illustration at 5.7, but the real rate of return is actually going to be closer to 11.5% years 3 through 20. So the PAC illustration, the rate of return behind the distribution numbers in your accumulation values is actually closer to 11.5%. It's not the 5% you're running it at. And the difference is the big bonus that they're generating. So there's a bigger bonus attached to their product that's running the illustrations at a higher rate. And one thing I want to point out is that their charges are about 2 or 3 times higher, and those charges are going towards fueling that bonus. So this is a little bit more of a risk and reward product. The reward is you have a bigger bonus, so if the market outperforms, you're going to get a higher return. The risk is you have higher fees, and the fees are really the downside risk within these products, because if you get a 0 or a small return one year, those fees are still coming out every year regardless of the performance. And here's the third competitor we wanted to share with you. This is the John Hancock Accumulation Iul. They have a guaranteed bonus. So PAC's bonus isn't guaranteed, but it's built into the illustration. Hancock's bonus is guaranteed. It's a 55% bonus that begins year 1. So again, higher fees, a more leveraged product. You're paying for the big bonus, driving the returns and the growth. And when you run this illustration at 6.12, it'll actually calculate closer to 9.5% each year. So the big takeaway here is that there's some products out there that are unleveraged, so lower fee schedules, lower downside risk, modest bonuses, and these illustrations run at lower rates of return. You know, more like fixed income returns, like the Symetra product, 6 to 7% per year with bonuses included. And then you'll see products like the PAC product or the Hancock product or the new Lincoln product that just came out, which are more leveraged IULs. So you'll see significantly higher fee schedules driving much bigger bonuses. So if you're putting an illustration in front of a client and you've run that at 100%, you say, Mr. Client, 20 years from now, we'll be able to provide you $100,000 in income tax-free from this policy. In order to get to that 100% number, these are the rates of return that in real life that the insurance company needs to generate within the policy to give Mr. Client his $100,000 20 years from now. All right, now here's the performance numbers, right? So we looked at 3 carriers with the same funding scenario. We analyzed the bonuses and the rate of return that the illustrations were running at. But here's where this all leads us. Here's the performance. This is the 20-year cash value. So this is the number that's driving a lot of customer buying decisions. We didn't show distributions in this example, so we're looking at cash values 20 years out. So Hancock is the top performer. Hancock would have provided your client $736,000 in cash accumulation 20 years later. Symetra's number 2 with $733,000. But one thing I want to point out is that for the extra $3,000 in cash value, you're taking on 2 or 3 times the downside risk. The fees are going to be 2 or 3 times higher, and that's going to take away from policy performance when the market's down or level or you're getting a small return. So the break even isn't 0. 0 isn't your hero. In these leverage products, it's more like 5 or 6% to break even. So again, bonuses are product specific. They're major differentiators. You need to understand how the products or how the bonuses work in the products you're recommending. You need to understand if they're guaranteed or not guaranteed, and how much of the performance is being driven by bonuses. So the second piece of content we wanted to share with you today is some work we've done around stress testing. So we had a call with a gentleman that's been in the industry for 40 or 50 years earlier this week, and he was saying that insurance products frustrate him because he feels like he's never sold one that's performed as illustrated. Fees have gone up or caps have come down. There have been changes to the business that he sold, and they don't perform as they illustrate when he's selling them, and that's frustrating. And, we see this in the business as well. You see carriers out there increasing fees on enforced blocks of business or decreasing caps as options prices increase. And then you have these bonuses that could be non-guaranteed, so there could be changes to those down the road. So how do you account for all the risk within these products to set fair expectations for your clients? And what we want to do is set fair expectations on the performance variables that are driving their buying decisions. So how do you set expectations fairly for distributions and accumulation values 20 or 30 years down the road? And how much risk is associated with underperformance in these specific products. And then we'll look at some products that are built to hold up under stress. So here's our method of stress testing. It's proportional reduction. So we would look at 3 carriers, 3 examples here. Everyone has a different cap. Everyone has a different illustrated rate. And what we're going to do is take them down proportionately. So we'll do a 100% run and see what everyone's performance is at 100% of the historic average, assuming no change to the product over the next 20, 30, 40, 50 years. And then we'll do a run at 85% of the illustrated rate. That'll assume underperformance of 15%. And then we'll do a run at 70%, which will assume underperformance of 30%. And what we're really looking for is the change in value. This is the standard deviation associated with underperformance. This is the risk in the distribution. And what we'll typically find is that there's going to be a sports car on here that's going to generate the highest return at the 100% run, but then as soon as performance falls off, you'll see that the income falls off substantially, disproportionately to the other carriers we're looking at. And typically this will be driven by a high cost chassis and a big bonus. So let's get into some real numbers here. This is the practical application of the stress testing that we've done. What I want to share with you here is a 45-year-old male. He's paying 20 years of premium into an accumulation product, and then he's going to turn on retirement income for 20 years using standard distributions. You'll see that there's some carriers on here that are more sensitive to underperformance, meaning when the product underperforms 30%, their distributions fall off 50 to 60%. There's other carriers on here that hold up a lot better and fall off more proportionately to the underperformance in the product. And if you look at the 20-year cumulative costs, you'll typically find that products built on customer-friendly, low-cost chassis hold up better should these products underperform or this market underperform out there. Here's a more extreme example. This is a 1035. So this is a single pay where same 45-year-old gentleman, this time he's bringing over $250,000 in a 1035. We're going to let it bake inside the policy for 20 years and then turn on retirement income distributions for 20 years using standard loans. You'll see that there's 3 products on here, really 4, that if there's underperformance of 30%, they can't provide any distributions. So this is a gentleman that was sold an insurance product that showed $50,000, $60,000, $70,000 coming out 20 years later. And now because caps came down a few points in the first couple of years, maybe you hit a couple early zeros in the market, we can't get any income out of these things. So this is the risk associated with underperformance in the products that we're recommending and selling out there. Should there be any underperformance, some products won't return the distributions that drove the customer's buying decision in the first place. So we're just trying to highlight some risk associated with different products out there. Here's a real sweet spot for Symetra, and this is the 1035 exchange market. We've had some great success over the past couple of years taking over business. It's driven by policy review. We have advisors out there meeting with their clients, reviewing their in-force policies, and what they found, so we had one example where we pulled over, so I think it was $5.5 million in a 1035. And this lady, they had dropped caps on her in her in-force policy. They had gone down from 10 to 8, I want to say. So they had reduced her upside. She started digging through her statement and realized she was paying really high fees. And what the Symetra product presented was an opportunity to move into a product with great upside potential, a 0% floor, and some of the lowest cumulative costs in the industry. So we were able to offer her a much more customer-friendly product, and it was really a win-win for everyone involved. And what we're showing here is a 60-year-old 1035ing over $500,000. And I want to point out that Symetra has the best cash accumulation 25 years out. So age 60, at age 85, approximate life expectancy, Symetra has the best cash accumulation at the 100% run. We're outperforming carriers like PAC and Hancock with the performance multipliers and all that good stuff. When we stress test down to 85 and 70, Symetra is still the top carrier for 1035 exchanges. And our target is about 20% higher than anyone's on there. And we have some of the lowest cumulative costs in the industry. So this is a real sweet spot for us if you're working with any clients that are in cash accumulation products now with downside risk or high fees, or maybe the upside potential's been reduced on them, give me a call and take a look at Symetra, and we could present a great opportunity for you. So if you can get behind some of our silly analogies and the weather and the cars, we think the Symetra accumulator stacks up in the industry as the high-performance SUV. We're up there with the sports cars and the fast track on the sunny day, and then if it starts snowing or raining and those cars pull over and throw their hazards on, we're going right by them. And just some quick takeaways about the Symetra product. Again, high distributions out, high targets. We have some guaranteed bonuses built in. It's one of the lowest cost IULs out there in the market. So, thank you folks for joining us this afternoon. I guess we could open it up to questions now.
Thanks so much, Matt. If anybody has any questions, feel free.
I got a question.
Sure.
On the other product, the more protection-oriented product, is it a similar platform where the costs are low?
Yes, sir. Yep. So here at Symetra, we have a slogan. It's VTS, Value, Transparency, and Sustainability, and those are the values that we take into account as we build products and continue to grow our business. So you'll always see Symetra come out with market-leading products that are built in a customer-friendly cost chassis. So yes, sir. Yep. So keep an eye out for that, and that should be coming out the end of March.
Does that product also have any long-term care chronic illness benefits?
Yes, sir. So great question. Thank you for the question. All of our permanent products, so our GUL, the Accumulation IUL we just discussed, and the Protection IUL coming in March, have two flavors of chronic illness riders. So the first is an embedded rider that's included on all policies that receive a standard or better rating. So your customer comes in, applies for insurance, they receive a standard, standard plus, preferred, or super preferred, they automatically get our embedded rider. I call this a nice to have. It gives the client access to 50% of the death benefit up to $500,000 if they qualify. Qualification is impairment of 2 of 6 ADLs or severe cognitive impairment. The condition does not have to be permanent, and we pay out as an indemnity program, so no receipts, no medical reimbursement. As long as the client qualifies, we send their money. Now, the embedded rider has a back-end charge, so if you use it, we charge lien interest based on a bond index against the remaining death benefit. So it's a nice to have. If the client needs it, it's on there, and they can utilize it. If you have a client really
a discounted claim.
Yes, sir. Now, the Chronic Illness Plus rider is separately underwritten. There's a separate charge for it. It adds about 6 or 7% to the premium. And this is a Cadillac version of the rider. It opens up 100% of the death benefit, paid out as a monthly income stream of 2% per month, up to the IRS per diem limit. Charges stop, waiver of premium, no back-end lien stuff. And one of the real differentiators of our chronic illness riders is that you can use them both together. So imagine a case where a client has a stroke or is disabled, and they could either go into an assisted living facility or go back into their home. You could leverage the built-in rider and take up to $500,000 and use that for renovations on the home. Maybe we need to install a wheelchair ramp or widen some doorways. We can use the lump sum rider for that sort of thing, and then we can turn on a monthly income stream with the plus rider thereafter. So you're able to pull a lot of money out of these policies quickly if you use both the chronic illness riders. So that was kind of a long-winded answer to your question, but yes, the protection product, the accumulation product, and our guaranteed UL all have two chronic illness riders on them.
Does anybody have any more questions? Okay, well, we will send out a recap email with this Matt's slides, the recording of this presentation, and then some additional kind of marketing pieces that Matt will provide us. We also have the retirement $11.54 an hour piece that we can customize for you all, so we'll include that in the recap as well. And feel free to respond with your logo and information, and we'll be sure to get that over to you. So thanks again, Matt. We really appreciate you doing this. This is a great presentation, and we hope everybody has a great rest of their week.
Thanks for having me on, Morgan. I appreciate it.